Hello everyone, welcome to the Economists Diary. In this video, I'm going to talk about the US Non-farm payrolls released last week. The US added 199,000 jobs in November compared to 150,000 previously, and the unemployment rate unexpectedly fell to 3.7% versus 3.9% previously, as about 25,300 members of the United Auto Workers ended the strike on the big three automakers on the 31st of October, which led to a decline in manufacturing employment for the month. At least 5,000 UAW members are still on strike. Most of them are from Mack Trucks, on 16,000 members of the Screen Actors Guild and the United Association of Radio and Television Artists returned to work and salaries were boosted. After the release of the data, the probability that the Fed will keep interest rates unchanged in December has risen slightly. According to the CME's Fed's Watch, the probability that the Fed will keep interest rates unchanged in the range of 5.25% to 5.5% in December is 98.2, which is 97.7 before the release of the data. And the probability of a 25 basis point rate hike is 1.8%, 2.3% before the release of the data. The probability of keeping interest rates unchanged by February next year is 92.2%, which is 85.9% before the release of the data. The probability of a cumulative rate cut of 25 basis points is 6.1%, and the probability of cumulative rate hike is 25 basis point is 1.7%. Analyst Katia said the labor force participation rate and the average weekly working hours have also risen, which is often a sign of stronger demand. The US Bureau of Labor Statistics noticed that unemployment in the manufacturing sector has increased, reflecting the return of workers from strikes. Employment in the retail sector has declined. Ailey Jeffrey, capital markets economists at Canadian Imperial Bank of Commerce, said, "Today's report is sure to draw some attention from the FOMC and serve as a reminder that the labor market remains tight. Although inflation persistence is no longer a challenge, the Fed will continue to be patient." Before other data, the number of private non-farm payrolls in the United States in November was 150,000, with an unexpectation of 153,000 and a previous value of 99,000. The US employment participation rate in November was 62.8%, with an expectation of 62.7%, and the previous value of also the 62.7%. The average working week was 34.4 hours compared to the unexpected 34.3 hours. After foreign media commented that the price below 34.0 will be an economic warning signal. Elian Ruskin, chief international strategist, said the 3 month average of private non-farm payrolls was fairly stable, in line with a downward trend in growth. But there was no significant deceleration. The 3 month annualized measure of hours worked is also stable, in line with the view that the potential growth rate of employment is stable, and the employment growth has not slowed significantly. Wage growth increased by 0.4% month on month, compared with 0.2 in the previous month, both stronger than market expectations. And wage growth increased by 4% year on year, compared with 4.1% in the previous month, which was basically in line with market expectations. Wage growth could provide support for a soft landing for the economy. And many have speculated that the current rise in workers' wages will help keep the US economy growing modestly without exacerbating the inflationary pressure they have been trying to process. With a recent jump in worker productivity and a reduction in average working hours per employee, the cost of labor per unit of output actually fell in the third quarter of this year, damping wage growth. So it means less convincing for companies to raise prices on the grounds of raising wages for employees. In a speech at the Pullman Institute last week, Fed Chairman Powell noted that while pandemic-era savings, which have been driving consumer demand, may be running out, rising wages have made up for it. Powell said that as long as the unemployment rate remains low, and with wages rising faster than inflation, there is no reason why spending shouldn't keep going. The Fed's hope is that the demand slows down enough to keep inflation coming down, but not for the economies to collapse completely and fall into recession. Slowing wage growth, strong productivity, and other data suggests that the labor market is moving closer to pre-pandemic conditions, and it will eventually support the Fed's current outlook for the economy to normalize. So that is the end for this week's video. Hope you guys will like it, and don't forget to like, subscribe my channel. See you in the next video.